Redington India. Mr. Hariharan, talk to us about that top line growth. A predominant part of that has come from Singapore, India, South Asia, what you term the CISA market. Talk to us about sustainability of that growth and what are the levers available elsewhere? What are the trends you're seeing in terms of top line growth elsewhere?
Very good morning. Thanks for having me on the show.
Very good morning.
Let me talk a little bit about the key drivers of growth. So we have 4 business units. The Software Solutions Group is growing at 40%, and that's across the world. And we're seeing the growth in India, Middle East, Africa, Turkey, and Southeast Asia. So in all of the markets we are in, we are seeing good growth in that part of the market. Our mobility business grew at about 15%. And this quarter, the PC also registered a good growth on the back of component shortage and the prices going up at 21%. So there were 3 key drivers. But if I go geography by geography, India registered a 25% growth, UAE a 19% growth, and Africa at 14%. There are markets like Qatar, Kuwait, the GCCL markets also grew. So you have a broad-based growth by geography and 3 of the business units pulling in very strong growth.
Hariharan, the one point that I wanted to pick up on is also about technology solutions. That particular cluster or group declined by 7% on an annualized basis for you. What's the reason behind that?
See, there are a combination of factors. So definitely linearity played out. And we have a slightly larger proportion of deals now in this business, combination of data center and on-prem server deals. And some of those deals you will see fruition and they can get recognized next quarter. We did close these deals this quarter. But overall for the year, if you look at it, it's been a 5% year-on-year growth. But there is also another factor that's playing out because of the movement of customers from on-prem to cloud. And the cloud business is infrastructure as a service with hyperscalers and others. And that's accounted for in our Software Solutions Group, which is growing at 40%. So clearly there are 2 factors. One, the linearity factor, and another is the on-prem to cloud migration.
What about margins that shrink with regard to margins? What's causing that, in your opinion? Is this product mix shift or what's playing out?
Yeah, so there is, again, a few things that's happening. One is the geography mix. So if you see, we have been talking about the last few quarters, because of what's happening in Turkey, we have been exiting some businesses in our subsidiary Arena. And Arena contributes to a higher margin, but because of interest costs there, we've been resulting in a loss. So we have been really getting out of the local lira business there. So out of the 47 bips in margin compression, nearly 2/3 to 3/4 is contributed by the exit of the businesses there and going after more profitable business. And the balance, you can say, is a little bit of a compression on TSG. But as we go forward, we don't see a structural problem on anything, and we're maintaining margins the rest of the business. And as Software Solutions Group scales, we definitely see margins come back to previous levels, but the TSG margin compression will continue for a while.
There's one vertical where there could be upside. Is margins in around the 2.3% kind of band something that one can fairly expect? And going back up above the 2.3%, will that be much more harder, you reckon?
See, our guidance has been the EBITDA margins at 2.3 to 2.5. Our goal is still to maintain the 2.3 to 2.5 range. I don't think what we see this quarter is an indicator. We'll definitely be working towards the 2.3 2.5% range, and we are reasonably confident we'll maintain in that range.
Right. Okay. The other thing I also wanted to understand right now is about your, working capital improvement to about almost 28 days now. But Q3 FCF was only about 217 crore rupees. So should investors expect volatility in the quarterly FCF given the distribution-heavy model, or you think that FY26 is a structurally inflection year?
Not really. I think the I can't say there's an inflection here. I mean, this quarter particularly, there are 2-3 things that play to our advantage. One, the mix of business towards mobility is one area that has helped us on the working capital side. Also, the Arena business consumed a lot more working capital. By exiting some of the businesses in Arena has actually improved our working capital. And fundamentally, there has been a lot of focus both in India and Middle East in terms of improving working capitals. Typical guidance on working capital is 35 to 40 days, and which is healthy for our businesses. And if we look at our peers as well, 28 days has been unusually good. But we think as we drive our focus more on the SSG and the TSG part of the business, working capitals will increase because these are longer cycles in terms of DSO and inventory and things like that. There's no inventory in SSG, but in TSG you do have inventory. So we do see 35 to 40 days as our general guidance on working capital.
Mr. Hariharan, thank you so much for joining us and giving us that perspective. We'll let you go on that note. And viewers, of course, that margin guidance being maintained, and despite that,